Alternative financing for small businesses. This video is brought to you by the Office of Minority and Women's Business Enterprises, with support from the Department of Financial Institutions and Community Bankers of Washington. Let's look at alternative financing options for small businesses. Historically, many small businesses have obtained financing through commercial financial institutions. The business owner establishes a relationship with a financial institution that extends a line of credit. That credit line enables the business to access funds as needed, up to the credit line limit. Because this traditional financing option is less available now since the 2008 financial crisis, alternative financing sources have become more important. Let's take a high-level look at some of the common ones. You'll find more information on each option by visiting our website at www.omwbe.wa.gov. Small Business Administration loans are a popular option. The SBA participates in several programs designed to help businesses that might not qualify for a traditional loan. The agency works with financial institutions that make loans to businesses that meet SBA requirements. The SBA then guarantees the loan and agrees to pay back a portion of it if the borrower defaults. Credit card financing might be an accessible way to start a small business, but it's not optimal. Unlike a grant, the money is not free. In fact, interest rates can be very high, and repayment terms are usually restrictive. If you use credit card financing, choose a card with the lowest interest rate available and avoid extra fees. In peer-to-peer lending, often called P2P lending, individuals or companies make direct loans to unrelated business owners. There's no traditional go-between, such as a financial institution. Lending occurs mostly online, through marketplaces like Lending Club. Businesses that seek financing are ranked according to their default risk. For example, an A ranking would signify low risk, and an F ranking, high risk. P2P lending is popular because the application and approval process is relatively quick. Interest rates might be lower than those offered by a financial institution, and borrowers with less than perfect credit might find a lender. Make sure you understand the terms and conditions, especially the default and remedies clauses. In the merchant cash advance model, also called credit and receivables financing, the business essentially borrows from itself. A merchant cash advance firm extends a loan based on revenues the business expects to receive. The business pays back the sum borrowed plus a fee, typically 25% or more of the amount advanced. A merchant cash advance can help in a cash flow emergency, but it's an expensive option. And because these companies aren't regulated like financial institutions are, borrowers might encounter unethical lending practices. In accounts receivable factoring, lenders, known as factors, purchase the business's outstanding invoices as collateral. This enables the business to convert slow-paying receivables into cash. There are two options. You can finance the receivables at about 65 to 85% of the invoice's face value, and the lender receives between 15 and 35%. Or you can sell the invoices to the lender at 70 to 90% of their value and let the lender collect the debt. Purchase order financing is like factoring, except that lenders get more directly involved. Lenders guarantee a purchaser's order of the company's products and pay for the goods to be manufactured. When the product is delivered, the lender takes a portion of the purchaser's payment. Crowdfunding is a relatively new option. It involves financing a business venture by raising cash contributions from many individuals, typically through the internet. One kind of crowdfunding is rewards crowdfunding. Entrepreneurs pre-sell a product or service to launch a business without incurring debt or exchanging equity. Instead, contributions might be exchanged for current or future goods or services. Another type is equity crowdfunding, in which backers receive shares of the company in exchange for the funds they pledge. Kickstarter and Indiegogo are popular crowdfunding platforms. Washington passed new equity crowdfunding legislation in 2014. Companies can now raise up to $1 million during any 12-month period through contributions from both accredited and non-accredited investors. Before, companies could only sell equity to accredited investors, individuals with a proven net worth of $10,000 or more. For more detail or specific business guidance, reach out to industry experts. Your banker, accountant, or counselors at the SBA can be helpful resources. You'll find more information about alternative financing options on our website, www.omwbe.wa.gov.